Welcome back to Morning Trade Live. Time to go inside out now on Salesforce ahead of its earnings after the close. Joining us now is Melissa Otto, head of Visible Alpha Research, S&P Global Market Intelligence. So thank you so much for joining me around the desk this morning. What are your expectations?
Hi, Sam. It's great to be here. I think what we're seeing in the Visible Alpha consensus data is that, not too much surprise on the revenue level. Basically, we're seeing that the market is expecting about $10 billion in revenues. Mm-hmm. But where we're seeing the story really evolve is around the margin.
Okay.
In the subscriptions business, we've seen margins grinding upwards for the past 2 quarters, and right now it's trading, consensus is around 85.5%, which is below last year's 86% level. So the question is, do they get that operational efficiency maximized to a level where they could return to last year's operating profit margin levels for that subscriptions business? That potentially is where the alpha may live in the story.
Is that the key part to focus on as we look at this earnings report? It's the margins. Is that what you would implore investors, traders to keep tabs on?
That's what we're seeing. I mean, there's another piece to this too. So the other segment around professional services has been loss generating, but what we're seeing also in the data is that the losses are continuing to grind smaller. Mm-hmm. So if the losses come in a bit lower than expectations, that too would provide some level of surprise going forward.
Okay, and no doubt it's been a bit of a tough old year as far as the stock is concerned. I mean, I just see it is underperforming year to date, down some 24% or so. I'm just wondering, what you think has been driving that, and what they need to come out with in order to turn things around as far as a bit more conviction here from the street.
Yeah, we need to see that top line either maintained or exceeding expectations, mm-hmm. and we need to see that operating efficiency returning to last year's levels or exceeding it.
But I mean, clearing the bar as far as the numbers are concerned, as we've seen this earnings season, it's just not enough.
Yeah, it has to exceed the expectations. It has to exceed where the market chatter is, mm-hmm. and given the valuations for many of these mega cap tech stocks, it's been challenging. But I think with a company like Salesforce, where we've seen some underperformance, there's some wiggle room in the numbers, potentially on the margin side, where we could see some upside as well. Okay,
expectation of $10 billion in revenue, as you say. Obviously, a huge contributor to that has been AI, as far as Agent Force is concerned. I'm just wondering, as far as the composition, give us a bit of color as to what that's likely to be. What's likely to drive that double-digit figure?
Yeah, it'll be interesting. AI is a fundamental aspect to their strategy, so it'll be interesting to see how they monetize that. And this has been the real question from the market is, okay, great, you've got this AI strategy, but show me the money. Show me where it's going to actually drop into the margin. Where is it going to drop into revenue growth? And I think we really haven't seen that yet. There's been a lot of chatter about it. There's some noise in the market that they're going to shift around their workforce. But I think the market is really just waiting to see where the rubber hits the road with that strategy.
It's a question I think the market has for a lot of these companies, particularly on the AI story.
Definitely.
Show me proof of all this spend. What will you do for me? We're still looking at the use cases as far as how these AI applications are actually being implemented into everyday life. Just wondering, as you look across the board, the earnings season thus far, as to any sort of clues, hints we could get from some of the competitors in this space, where Salesforce sort of sits in the grand scheme of things.
It's a really interesting climate at the moment. One of the most interesting takeaways so far this earnings season has been that we've seen kind of a shift away a bit from big outperformance at the infrastructure companies.
Yeah.
So you're talking about, for example, NVIDIA. NVIDIA had a good quarter fundamentally, but it was a bit meh relative to expectations, so the stock's been a drag. And then, on the flip side of that, the software companies, the data companies, MongoDB, a couple of quarters ago, was hated. It was a hero this quarter. Elastic, I think that company came out of left field. So I think kind of seeing this shift a bit in AI plays, more focusing on data and around that kind of software-esque area of the AI story, as opposed to the GPUs, servers, et cetera.
Yeah, I think the semi-software spread has been certainly interesting as far as some of that rotation has been
Indeed.
concerned this year. Very key to watch. Melissa, we're going to have to leave it there, but thank you so much for your time and joining me on the program today. It's been an absolute pleasure having you around the desk here on the trading floor. That was Melissa Otto, S&P Global Market Intelligence.
Thanks, Sam.
Thank you. Let's trade it now with Tom White, host of Fast Market. Good morning to you, Tom. Take us through your bullish example trade first.
Yeah, so near-term implied volatility, Sam, really elevated at this point. IV percentile rank up in the mid-60s, so over a 52-week period, it's pretty elevated to comparable to where it's been. And that should be expected, right, going into this report. So I looked at a strategy. If you think this stock is going to move higher, it's in bear market territory going into this report. So the bar is actually relatively low in CRM. So I looked at a bullish call diagonal in here. It's a couple weeks in duration also. It's not a pure earnings play, but you're taking advantage of that near-term higher implied volatility. So going out to the September 19th monthly options that expire in just 16 days, we're going to buy the basically at the money, slightly in the money, 252.5 strike call. And then against it, we're going to use what the option market's pricing in right now for a 1 standard deviation move, which is about 7% either way, or just over $17. So that lines up with selling in the near term, the September 5th weekly 270 strike call. So you're buying the 252.5 strike call in the September monthly options that expire in 2.5 weeks, selling the near term September 5th weekly 270 strike call. So a bullish $17.5 wide call diagonal. You're going to pay roughly about an $8.80 debit for this. That's going to be your risk, $880 per spread. But you can see here from the risk profile, anything above about 257 is going to be profitability. Now, where do you want the stock to go post earnings tomorrow? You want it to go up at or near that 270 strike. But because it's a $17.5 wide call diagonal and you're only paying $8.80, anything above about 257 is going to be profitability. You start to lose some profitability above 270, but it's still a bullish play here. Now, the key is, why does it cost less than the width of this call diagonal? Well, that's because you're buying about a 55% implied volatility on aggregate in that September monthly option, where you're buying the 252.5 strike call, and selling about a 120% implied volatility in the near-term September 5th weekly options on aggregate in that 270 strike call. So that dispersion between implied volatility levels really lowers your risk on this trade, but it's definitely a directionally bullish trade. You need the stock to kind of grind higher. Ideally, you want it at or near 270, but like I said, anything above 257 is going to be profitability on this one.
Okay, and what about a sort of more neutral example trade for this one, Tom?
Yeah, so I mentioned that higher implied volatility in the near-term options. That's where you have that event risk tonight after the close due to that higher option premium. So I want to take advantage of that. If you think the stock's going to consolidate post-earnings or have little movement, maybe within that 7% move up or down, this strategy takes advantage of it. Using those September 5th weekly options, so just 2 days to expiration on this position. We're going to sell an out-of-the-money put vertical. We're going to sell the 240 put, buy the 235 put. And then on the call side, out of the money to the upside, we're going to sell the 275 strike call and buy the 280 strike call. So you have two short verticals, one on the downside on the put side, and then one on the upside on the calls. And this creates that neutral strategy. $5 wide short iron condor. You're going to collect roughly about a $2 credit on it. That's what you can make, $200 per spread with $300 at risk. But that's all the way below 235 or above 280. Now, if you collect that $2 credit, it takes your break evens that you want the stock to remain between about 238 on the downside and 277 on the upside. So you've got a nice wide range for this stock to trade in, about that 1 standard deviation on both sides, where if you think that higher implied volatility allows you to collect that $2 and you think it's going to consolidate, this strategy takes advantage of it. And you'll get that vol crush tomorrow, and time decay or positive theta is in your favor also. That'll reduce the price of this where you can buy it back cheaper.
Okay, a good look at Salesforce and some of those example trades at CRM under pressure this morning as we look ahead to those earnings. Thank you so much for that, Tom White. Appreciate it.